One of the more under-the-radar benefits of VA loans is that they're assumable. Instead of selling your home, you might be able to have another person, a veteran or a civilian, essentially take over your mortgage and your interest in the property. That includes your loan balance, your interest rate, and your monthly payment. Loan assumptions and traditional home purchases differ in some key ways. Not all VA lenders and servicers allow for assumptions, and they have the potential to put your VA loan entitlement and your credit at risk. In a typical purchase transaction, the buyer is getting a mortgage to purchase the home, and the seller is using the proceeds of the sale to repay their loan in full, which shifts the financial obligation for the property solely to the new owner, the buyer. The seller can also look to restore their full VA loan entitlement once they've repaid that original VA loan in full. Things can look different with a loan assumption. Just like with a typical purchase, lenders will vet the credit and finances of the person assuming your loan. But unlike a home sale, your legal liability for the debt doesn't automatically disappear once the assumption is complete. Homeowners have to ask for and obtain a release of liability from their mortgage lender or servicer. This is incredibly important. Without a release of liability, VA homeowners could take a major credit hit if the person assuming their loan later makes late payments or defaults on the mortgage. Another huge consideration with assumptions is VA loan entitlement. If the person assuming your loan is a veteran with sufficient VA loan entitlement, then you can ask them to formally substitute their entitlement for yours. Otherwise, the entitlement that you used to purchase that home stays tied up in that property until the loan is fully repaid. Failing to get a substitution of entitlement can limit your zero-down buying power when it comes time to reuse your VA loan benefits. What's worse is that veterans would lose that portion of their entitlement entirely if the person who assumes their loan later defaults. These are some of the big considerations and potential concerns with assumptions. Now, in terms of the potential advantages, having an assumable loan can be a big help if you're looking to sell during a time of rising interest rates. Let's say that you bought a home a few years ago and got a rock bottom rate. But if rates have been on a rise since you landed your VA loan, anyone who wants to go out today and get a loan to buy your home is probably getting stuck with a higher interest rate than what you have, unless they can just assume your loan. In that case, the buyer gets to take advantage of the lower rate that you locked into years ago. Most of the closing costs associated with a closing on a home loan aren't part of an assumption either. But the person who assumes your loan does have to pay a funding fee. It's not the same amount that you typically pay in a purchase transaction. It's 0.5% for a VA loan assumption. This funding fee goes directly to the VA, and it helps keep the program running for future generations of military buyers. Veterans who would normally be exempt from the VA funding fee are also exempt from paying this fee for an assumption. The key with a loan assumption is making sure to safeguard your VA loan entitlement and your financial future. VA loan assumptions aren't incredibly common, but the ability to have someone assume your loan is a potential benefit when the time comes to sell. And it's a benefit that you won't find with most conventional mortgages. Talk with your lender or servicer if you have questions about VA loan assumptions.